Hello, everyone. Adam Bergman here, tax attorney, founder of IRA Financial. On today's video, I'm going to be discussing the 2023 real estate trends for self-directed IRA and solo 401k investors. So I think this is an important video. I've spoken to quite a few real estate investors over the last several weeks. Obviously not all. I got about 25,000 clients. So lots of real estate investors amongst the 25,000 or so clients. So clearly I wasn't able to survey all of them, but I did speak to several of what I think are some super smart real estate investors that I've worked with over the years and tried to get their thoughts on the trends that are impacting the real estate world in 2023 and what they've seen and what they're thinking about as a IRA investor. So here we go. Let's get started. I'm going to go through some of the trends and ultimately, explain the impact on the overall real estate market, and then ultimately on self-directed IRA investors as well. So the first trend, obviously, we'll start at the category that we all are experiencing, and that's prices are high, right? Real estate prices remain high in 2023, and we'll go through a variety of reasons why they're still high. But here are some statistics. In January 2023, U.S. home prices were up 1.5% compared to last year, selling for a median price of $383,460. On average, the number of homes sold were down over 34% year over year. There were 272,305 homes sold in January this year, down from 414,028 homes sold in January 2022. Okay, so that's a pretty big number. So what do we have going on here? We have high interest rates, which we'll get to in a sec. We have high inflation, which we'll get to in a sec. Prices are still high. Strange, right? Because you would think high interest rates, inflation, less buyers out there because it's more costly to get a mortgage. Why are prices still high? 1.5% increase over year. And again, 22 was higher than 21 and 21 was higher than 20. How is that even possible? Well, there's a couple factors. Number one, supply and demand. There's not enough homes being built. So there's still greater demand than supply. What I think the most telling reason is wages. There's still very, very low, historical low essentially unemployment, right? So when you have very, very low unemployment, people are comfortable with their jobs. They're making more money, right? Inflation, people are earning more money. And even though interest rates are higher, people are still confident and comfortable in their position from an employer-employee standpoint, and they're willing to spend a little bit more on a home because they're confident and secure in their job. So that is what I think is super telling about why prices remain high. And we'll see where that goes. I still think they're going to stay high. The only thing that I think could have an impact on this is insecurity in the wage market, where people are losing jobs. We've seen layoffs at big tech companies, but it hasn't trickled down to middle America. Average Americans. IRA Financial, we're hiring. A lot of small to mid-sized businesses are hiring. So people are still secure, and people are not as deterred as you would think from higher interest rates. So we'll have to keep an eye on that, but that's the first trend. The second trend we talked about is inflation. The national average 30-year fixed mortgage rate is at 6.3%, and that's up 2.8 points from last year. So high inflation means high mortgage interest rates. 6% is high. It's as high as we've seen it in many, many years. But as I mentioned, it's not deterring folks from buying homes because of the security they have with their job. They've received increased wages, higher bonuses, and they're secure. They feel like there's a very strong job market, so they're not worried about losing their job. And ultimately, it's a supply-demand issues. We need more homes being built, and that's just not happening right now. And it probably won't this year with higher interest rates. So I still think prices are going to remain, relatively high in 23, which is surprising, right? When you look at the fact that mortgage rates are higher, you have inflation, um, less sales out there, you would think prices should drop, but they haven't. They're still up 1.5% from 22, which was a really strong year, which is pretty shocking. Cash is still king, right? At the end of the day, if you don't need a mortgage, you have an IRA, a 401k, and you can buy a home with all cash, you're going to get the deal. Um, you're just going to be able to get that deal done. You'll be able to close quicker. It's harder to get a mortgage today. It's more strenuous. So if you have cash, and the IRA, 401k investors tend to use more cash, or all cash in many cases, you're going to have a big advantage over everyone else. It's a better investment market for IRA and 401k investors. Why? Less investment funds involved, right? I read somewhere that Zillow, they shuttered their home flipping business. They lost $881 million in 2021. So you also read about BlackRock curtailing some of their investments, and a lot of private equity slash real estate funds have also curtailed their estate purchases of rental properties across the United States, mainly in large population states like Florida, Texas, Arizona, growth states. That's impacted the market, no matter what they're saying, but it has. When you have billions and billions of dollars floating through the economy and looking to gobble up homes to rent out, that's going to have an impact on prices, and it has. But that's an area that at least the real estate investors I talk to, feel that could have some pressure on pricing, because those startup slash investment funds slash digital investment funds that were so prevalent in the marketplace the last 5-6 years have really kind of on the sidelines at this point. So we'll see the impact that has on pricing. But the real estate folks I spoke to think that it really could have an impact and potentially pressure prices down. So some of the hot businesses, they talked about hard money lending. They think that's going to be a very strong trend in 23 and beyond, with mortgage rates higher, more difficult to get mortgages, banks a little bit tighter. Hard money loans, especially for commercial real estate projects, short-term loans, whether it's 6 months, 15-month type loans. They've seen a lot of activity in there, and also the ability to get somewhat aggressive on interest rates. The rates I'm hearing is anywhere from like 9 to 14%. Obviously, the more leverage you use, the higher the interest rate. If you're going to put 40, 50% equity down, you're going to probably be at the lower end of that 9%. The less cash down, the higher rate. Obviously, depends on what you want to buy. If you're buying, commercial versus residential, things like that. But look out for hard money lending. That's an area I think you're going to see a lot of interest from self-directed 401k investors, because of the potential opening from traditional lenders that have kind of moved again to the sidelines, kind of weighing this out, seeing where rates are. Rates potentially keep going up. So a lot of hard money lenders aren't as concerned, because they're not looking to do 15, 30-year mortgages. They're more focused on 6 months to 2-year, 3-year type short-term loans. So they're not as worried about interest rate volatility. So that is an area that I kept hearing from multiple clients that, hey, that's an area we're looking in. We're still looking at flips, but we're more focused on doing some hard money lending, because we think there's growth areas, and depending on the amount of capital down, and the fact that inflation, the assets should keep rising in value, they feel pretty secure, even if it's like a non-recourse type hard money loan. Fractional real estate, right? We're announcing we're going to start doing partnership with Realty Mogul. I'm going to offer that some exclusives to our clients, but there's a big movement, and this is even from traditional real estate investors that really don't have any fractional real estate models that they're working with, nothing on their platform, and that's something they've talked about getting into. Why? With home prices going up, when I always give this example, I think it was about 2011. I was interviewed by CBS News in Fort Myers, because I had a client that was doing some fix and flips, and I got invited down with my PR team, and we got interviewed and explained how people use their IRA to flip homes, and all the profits from that flip would go back to the IRA without tax. And obviously, that's the main advantage of using an IRA or 401k to buy real estate, is there's no tax on the rental income and no tax on the gains. There's no short-term capital gains. There's no long-term capital gains. You don't have to worry about basis, holding periods. It's all tax-free or tax deferred in the case of a traditional or IRA or 401k. So that's the play with using retirement accounts to buy real estate. And I remember going back to 2011, like the home prices were like, it's under 200K. And I remember walking in this home, a swimming pool, like enclosed swimming pool, 2-story home. I was thinking to myself, like, this is like kind of nicer than my house. Holy cow, like 200K, you could buy this house. Now that home's probably 500K, right? So less and less people have available cash in their IRA or 401k to blow 400 or 500K on a purchase, right? So what fractional real estate does is it lets you invest in an investment fund that will have, whether it's a REIT, whether it's just a partnership type arrangement, where you get exposure to different classes of real estate, whether it's a pool of residential properties, a commercial building, a hotel, office building, whatever the case may be. You don't need to come up with the cash yourself and actually operate the facility or the project. You can just passively invest through a fractional model, i.e. like a Realty Mogul, Yield Street, things like that, and get exposure to real estate, get strong returns, hopefully. Obviously, nothing's guaranteed, but at least you don't have to manage the property yourself, and you get expert, real estate professionals that are identifying these projects, these investment opportunities, and then you can passively invest. So I feel as well, just speaking to a number of these real estate clients, that they've mentioned themselves that, hey, like, I do this myself. I'm a real estate guy. I do flips. I'll do Airbnbs, but I'm actually looking to potential invest in fractional real estate platforms, just to put some money to work passively, where I just don't want to manage, and I just want to have more diversification in the overall real estate world. One said, I don't have enough to invest in commercial property or an office building, something in a grade class A type office building in Nashville or Dallas. Just don't have that type of money in my IRA, but I can easily put in 50 or 75K in this project, and hopefully, the project is geared to return 14 to 15% annualized. That's interesting and something I can do passively. So I do think you're going to be seeing a lot more interest from IRA and 401k investors in fractional real estate, and that's why we're looking to partner with some of these great platforms and just offer these exclusive opportunities to our clients that have the ability, if you're accredited, of course, to kind of jump in and invest in these projects passively and get exposure to different types of real estate classes. Airbnb type investments are still hot. People are spending a lot of money on travel. I don't know. You probably are too. I know I am. I feel like I look at my credit card bill, and wherever we go, it's just more and more expensive, but we're not deterred, right? We're still spending money on traveling. Just spoke to a friend who went skiing last week, spring break. People are traveling around. I'm in Miami. There's a big boat show here last week. It's packed with people. So people are spending money on travel, and people are definitely comfortable with Airbnb type models. So just another hot investment area trend is investing in short-term rentals, Airbnb types, where they can generate strong returns, very little maintenance, and there's still strong demand. Obviously, some folks mentioned Vegas is a hot area. It doesn't, obviously not on the strip, but within 10 to 15 miles outside of Vegas, people are okay Airbnb and having a nice property with a pool, and then just driving into the strip and eating and gambling, that type of stuff. I spoke to someone after a Super Bowl that he lucked out. He had an Airbnb in Phoenix, and he's like, "You have no idea, Adam, what a killing I made the last week. I literally made more in a week than I can make in a year with these Airbnbs." So obviously that's a good case scenario. There's plenty that aren't performing as well as they could, but we're spending money on traveling, and obviously, if you have a good property and you can Airbnb it, it's great. Just obviously, you don't want to be doing any of the work yourself. And I'll finish the podcast just talking about the basic rules for investing in real estate, to tie in the self-directed IRA, 401k investors. And the last trend is joint ventures. With prices increasing, even if it's just 1.5% from last year, prices have pretty much doubled to 3 times over the last 7 years. Generally, over the last 4 years, it's doubled. So it's more expensive to get into deals, right? As I mentioned, 5, 7, 8 years ago, 250, you're getting a nice property. Now that's 450, 385, 450. So what folks are doing, whether it's family members, friends, colleagues, whatever, neighbors, they're pooling their money, whether it's IRA mixed with personal, IRA mixed with IRA mixed with 401k. They're doing a joint venture. They set up an LLC. Say Adam puts 100k in his IRA, John puts 100k in his IRA, Jane puts 200k in her IRA. They own the property together. Everything goes pro rata. Hire a management company. If there's day-to-day stuff needs to be handled with respect to the property, and it's a super passive type investment. Whether they're doing flips, rentals, Airbnbs, they're able to pool their money and still actually acquire that asset, which they would not have otherwise been able to do because of the increase in prices. So those are the trends, just from an investment standpoint. Just to summarize again, what I've been hearing is hard money lending, fractional real estate, travel type, short-term rentals like Airbnb, and then joint ventures, pooling money to get access to properties and have cash, because cash is still king. Even though mortgage rates are not, 6% is high over the last 10 years, but historically, going back to the 80s, early 90s, it's not terribly high. And with a strong job market, people have still have very strong security, work security. People are still getting mortgages. The issue is the banks are a little bit less interested to lend just because of the volatility in interest rates. So if you have cash and you don't have to deal with acquiring a mortgage, you're going to be in a far better buying position, and you probably are going to have a far greater chance to acquire the asset. So by doing a joint venture, that will increase your chances, obviously, of getting that. So let's talk about real quick about IRAs, 401ks, and some of the rules involved in the acquisition of real estate. So starting 1974, when IRAs were created by ERISA, the IRS didn't say what you can do, only what you cannot do. And there's essentially 3 things you can't do with an IRA. Collectibles, like antiques, rugs, stamps, life insurance, you can buy it in a 401k, but not in an IRA. And then the big category is prohibited transactions outlined in Internal Revenue Code section 4975, which basically says that you can't do anything in your IRA that indirectly or directly personally benefits or involves a disqualified person. A disqualified person is you as the IRA owner and your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities 50% or more controlled by such person. So you can buy a house, you just can't live in it. Your kids can't live in it. Your parents can't live in it. Daughter-in-law, son-in-law can't live in it. You can't rent it out to your business that you own more than 50%. Otherwise, you can do it. Domestic, international, commercial, residential, hard money loans, fractional, syndicates, investment funds, real estate. All those things you can do. Okay. Now, what about services? Well, 4975 says that the IRA cannot have really any connection to a disqualified person. And on top of that, under 4975, C1B talks about performance of services. So you're not allowed to perform services that benefits your IRA. Now, you can do what's reasonable and necessary as per the Treasury regulations. Obviously, you can pick the real estate. You could decide what you're going to rent it out at, decide if you want to paint the house white or brown, decide if you're going to put a pool in there or how much you're going to pay for landscaping. But you shouldn't do what's not reasonable and necessary, like fixing the toilet or mowing the lawn or painting the fence. Those things you should have a third party do. Now, what about buying furniture? What about buying the paint? What about buying any type of products needed for improvements for the house? You shouldn't do it yourself. So what I strongly suggest is just have a friend or a third party and just say, hey, here's my list. Go to Home Depot, go to Lowe's, go where Restoration Hardware, CB2, wherever. Buy this. Here's the choices from the internet. Go buy them, and I'll write you a check. Could you go by yourself with a debit card? Yeah, I think it's just cleaner. Have a third party buy it for you and just write them a check. Can't use a credit card. Why? 4975 does not allow you to personally guarantee an obligation or IRA. So you can't get a credit card, but debit cards, Venmo, Zelle, that's cool. You can do it. The thing to keep in mind, less is always more. So the less services you do, the better. If you can have a third party do it, have them do it. The third party should not be a disqualified person. Again, should not be a parent, child, spouse, daughter-in-law, son-in-law, any entities controlled by such person. So brothers, sisters, aunts, uncles, cousins, neighbors, colleagues, all good. So you can have them, pay them to do whatever you want. No problem. Just don't do it yourself, or do not have a disqualified person do it yourself. So, real estate's obviously a super attractive investment option. Why? Diversification, right? It's a hedge against inflation. It's a hard asset. Other folks just don't trust real estate. Don't trust Wall Street, right? No one understands why the market goes up or down. People want to have access to an asset they know and trust, hard asset they can, look at, drive by the home, say, hey, it's still there. Oh, look, the tenant's in there. Cash flow, right? You have, whether it's an Airbnb, whether it's a long-term tenant, paying you rent. You have the ability to increase rent based off inflation. Usually tenants don't sign 5-year leases. It's 1-year, 2-year lease. So you have some flexibility. So you can get cash flow. And obviously real estate has been a very strong performing asset class over the last 10 or so years. So the clients that I've talked to have done very, very well owning real estate in an IRA. What's the disadvantage of owning real estate in an IRA? Well, the main one is deductions and losses. An IRA is tax exempt under Section 408. Same with a 401k under 401, meaning it doesn't pay tax, which is great. But the IRS isn't going to let you also get deductions, right? You can't pay no tax and receive the benefit of deductions and depreciation. So essentially, if your real estate property, your investment falters and you lose money, your IRA just drops in value. The loss or the deduction or the net operating loss cannot be used to offset any other income, where it does if you own the real estate personally. So if you own the real estate asset personally and you had net losses from depreciation, you can use that potentially if it's an active real estate, taking into account Section 465, 469 passive activity loss rules. Potentially can use some of those losses to offset ordinary income or other investment income. In an IRA, you can't, right? The good news is you don't pay tax on the income or gains, no capital gains, no ordinary income, no short-term capital gains, no long-term capital gains, but you also don't get losses or deductions. So generally, for long-term investors, owning real estate in IRA is helpful. I have some friends that are real estate investors that don't buy real estate in IRA because they feel very strongly about benefiting from deductions, depreciation, amortization, things like that, accelerated depreciation that can help benefit and reduce taxable income from other areas. So from most of the folks I'm talking to, the idea is this: hey, I want to either diversify or I just trust real estate. I know real estate, it's a hard asset. I can sleep well at night. I know the house is there. I know I can always rent it out. Even if I rent it out for less than I think it's worth, I always have cash flow and I can always potentially sell it. Whereas stocks, last year was a tough year, and a stock that seems super hot suddenly can turn around. So some folks just don't want to deal with stocks, mutual funds, traditional investments that just go up or down for no apparent reason, whether it's the Fed making a statement or whatever. They just don't want to deal with it. So, or they have too much exposure to equities and other investment accounts, and they just want this IRA or 401k account to do something else. Whatever the case may be, you should know that obviously the IRS lets you do it. If they didn't want you doing it, they would have prohibited IRAs and 401ks from investing in real estate when ERISA was created in 74, but they didn't. So it's a very important asset class. One other thing to consider besides privilege transaction rules, which I've talked about in the past, is UBIT, unrelated business income tax rule, which is, 4-letter ugly word. Why? Because it could potentially trigger a 37% tax on a real estate investment. How would that be triggered? Well, really in two ways. if you use an IRA to acquire real estate and use a non-recourse loan to buy it, what's a non-recourse loan? It's a loan you do not personally guarantee. Why do you have to use a non-recourse loan with an IRA or 401k? Because 4975, just like a credit card, C, does not allow you to personally guarantee an obligation of your IRA. That is why you need to use a non-recourse loan, because you can't guarantee mortgage, just like you would with a regular old recourse mortgage. So that's why I always mention the word non-recourse. That's fine. You can acquire a non-recourse loan. We have plenty of lenders that will lend you the funds to your IRA or 401k. There's an exemption for 401ks under 514c9. You can use a non-recourse loan to acquire real estate without triggering the UBIT tax, which is a huge, huge boom for real estate investors. So that's why there's so many real estate investors that are trying to find ways to become self-employed or have a business with no full-time employees, so they can set up a solo K, get out of the IRA UBIT tax, and avail themselves of the exception under Internal Revenue Code section 514c9 and leverage up their asset without tax. As I mentioned, the highest UBIT tax rate is 37% as of the 2023 trust and estate tax rates. It follows the trust rates, and the highest rate gets triggered at a very, very low income level, approximately 15 or so thousand bucks. So it's not like your income tax return, where if you make over 650,000, you may hit the highest 37% tax bracket. With the trust and estate trust rates, it's at like 15K, which is obviously super low. So the second way you can trigger UBIT is if your IRA invests in an active trader business, a real estate management company, real estate developer that's operated through a pass-through entity like an LLC. And in both cases, whether it's the acquisition of real estate using leverage or investing in an active business that involves real estate through a pass-through, you have to have more than $1,000 in net income. So if you have losses, if you have less than $1,000, there's no UBIT. And the good news with UBIT is it's filed on a 990T. That's where you report it through April 15th. If you're a client of IRA Financial, we actually do it for you. We have that filing service. It's part of our annual compliance service. This is the first year we're offering it. Super, super, super psyched about that. We're the only self-directed IRA company that does that. We don't charge extra. It's included in our annual compliance fee. And it's obviously a huge benefit, because to go find an accountant that's going to file a 990T and do it right, it's going to cost you $500, $1,000, where our IRA annual compliance fee is $299, solo K is $399, and you're going to pay it anyways. So you get the tax filings, the 990T. If you have to file a partnership return, 1065, we handle that for you. Obviously 1099-Rs, 5498s, that's done as well, included. So it's a really important service, especially for UBIT. The problem with UBIT, if you're investing in investment funds, sometimes you don't even know how to report it. Why? Because you get a K1, and if the property manager or the investment fund manager doesn't report the UBIT on the K1, there's no way you can report it to the IRS. So that's why a lot of this UBIT kind of gets, I guess, pushed into a black hole, and it never gets reported, just because the investor doesn't have the data to report it on an IRT, because they don't get the data on their K1, right? So, and by that, estimation, the IRS doesn't generally know about it either, because it's not on the K1. If it's not on the K1, the IRS is not going to know that there's UBIT, and they're not going to go after the IRA owner and look for their 990T filing, because it's not being reported on the K1. So that's why it's kind of just what goes into this basically vacuum in space. And a lot of times it doesn't get reported. How do you block UBIT? The best way is really just setting up a C Corp blocker. Set up a Delaware, Wyoming, South Dakota C Corp, no state tax, 21 federal tax on the income allocated to the C Corp, and then the dividend from the C Corp back to the IRA is tax exempt. There's no UBIT on dividends. It's not perfect. It doesn't eliminate the UBIT tax from 37 to 0, but it could significantly reduce it from 37 to 21%, which is kind of like long-term capital gains at a higher rate. So it's not horrible. It's not perfect. Foreign blockers generally don't work, whether it's because of FIRPTA, branch profit taxes, different subpart F foreign tax rules that actually could impose a higher tax rate than the 21% if you just used a domestic blocker. If you pay off the loan and then sell the property after 12 months, there's no UBIT. Okay, but you have to wait that 12 months to sell the property. If you're a long-term real estate investor and you're going to use a non-recourse loan and you're going to hold that property 10, 15 years, then the loan hopefully will get paid off. And then when you sell that asset, you don't have to worry about UBIT. How much you need to put down if you want to get a non-recourse loan? It's generally about 30 to 40% down. You will pay a bit of a higher interest rate just because the lender is taking greater risk because there's no personal guarantee, but otherwise, it's a way to use leverage. And if you ask any good real estate investor, leverage is key, right? Because you can just buy more for your money, and the less money you use personally, OPM, right? Other people's money. That's really the game for really smart real estate investors. The more money you can borrow, the more assets you can buy with your money. So that's kind of the play. So there you go. It's about 30 minutes. So try not to go over the 30-minute. I know you guys have much better things to do with your day, but just wanted to share the trends because it's been a kind of a weird start to 2023. There's just no demand. Well, I should say there's very little supply. There's no home. The amount of homes being sold are like at an all-time low. I read an article in the Wall Street Journal recently that a lot of realtors are just kind of leaving the space looking for jobs, just because even though prices remain high, nothing's being sold. For whatever reason. I mean, just prices, homes are sitting, and there's no forced selling at this point. Why? Over the last 3 to 4 years, many of us bought homes, and we got really, really low interest rates, right? Anywhere from like 2.5% to 4%. And if you're not forced to sell because you still have a job, you're making more than you did last year, you got a raise, bonus, your spouse is working too. You're not forced to sell. So even if you have to move locations for work, you can rent it out, right? Whereas in 08, 09, there was forced selling, right? People were losing their job. They were overextended. Prices were dropping. They just had to get out. They borrowed too much. The banks have done a way better job, policing themselves, not just giving mortgages to anyone. So generally, it's been a higher degree of credit worthiness. People are just not buying homes with 0% down. Interest rates floating after a year. People are generally getting fixed rates for 5, 10, 15, 30 years. So with higher rates, it's not impacting as many folks as it would have in 08 because people have locked in very low interest rates. And unless the job market changes and there's a change in the level of security Americans are having in the job market, I don't see prices dropping much in 23. So knowing that, I think there's ways to get in and take advantage of it, whether it's through Airbnbs, fractional ownership, and joint ventures plus hard money loans. That seems to be what the smart real estate investors are looking for as trends in 2023. So appreciate you guys watching. Spend some time here today. It's a weekly video, 12 noon Eastern Standard Time every Wednesday. Don't feel bad leaving a comment, question. I do my best to get back to you. If you have questions on UBIT or real estate trends, give us a call. We have a team of really, really super brilliant IRA 401k professionals. And whether you're a client of IRA Financials or not, we're going to give you the answer. We have a phone number on our website. We're not hiding. We want to hear from you guys. We want to help you, client or not. We'll get you the right answer. So thanks again for spending some time here today. I hope you guys have a great day and take care.